Things with IRS going on. So some things are IRS, some things are proposed things. So we're going to just start off with IRS themselves right now. IRS is stretched thin. They have been reduced staff all last year. They, I don't know if they have still caught up on the 19 returns all being processed yet. That was a problem a month or so ago. Right now, we're seeing among our clients about 30%, and I'm sorry, not among my clients, from IRS. This information is from IRS. About 30% of refunds have been delayed. So if your refund didn't come out in that quick 2 to 3 week time like it normally has done from IRS, it will probably be 60 days or more. We have seen clients notifying us that they are getting interest paid with their refunds. So IRS is behind in processing refunds. If your refund is delayed, they will go ahead and pay you interest on that money just automatically. The other problem with IRS being stretched thin is anything that's got to be handled by a person has been delayed. So if we're doing any correspondence to IRS about an issue, that is being delayed. And we're seeing a lot of incorrect notices coming out from IRS. So because things that are a manual process are not getting into the system, the automated part of the IRS computer system sending out notices with penalty and amounts owed and balance dues is an automated system. And so that is happening concurrently, and there are missing things that have happened. And so we're getting lots of clients with incorrect notices too. So just be aware, any correspondence with IRS, if any of you have tried calling IRS, wait times are horrendous. Trying to get through to IRS, need lots and lots of patience for that. So do just have patience, anything that we're doing with IRS, because they are stretched thin. So it can be a problem for a lot of you, especially if you haven't gotten your refunds yet for that. So IRS, that's the issues they're having right now. The bulk of what I want to talk about today, because I really do like looking forward and being able to do tax planning with you. So the bulk of what we're going to talk about today is the proposed budget that President Biden has sent out. This is not law. This is not, I don't think there's even a bill yet at this point for them to start negotiating these things, but these are the things that are being proposed to be changes. So it's not the end result. We know as they go through all of the negotiations in Congress, we will see lots of things change. Things will be added, things will be deleted. So it might not look at all exactly, it will not look at all as we are seeing it right now, but they will keep working on that, and we will stay on top of it and keep you informed as it goes, things that are starting to look more likely. But at least this is giving you the areas of what they're proposing to make changes in. And really, I am only giving you a few of the areas, the ones that I feel are most relevant to business owners right now at this point. There are a ton of things in this. I have a 114-page summary. If anybody would like me to send it to them, I can. There's a lot of things with energy credits and et cetera, not getting into that. And not getting into anything that is on the personal side, looking much more at what business owners, what may be on your personal return as business owners. So there is a lot of information out there. So let's start off. The biggest thing, and we've been hearing this for a long, long time, is that they want to increase the top tax rate, which is currently 37%, up to 39.6%. That would be somebody with taxable income for a single individual. And I'm sorry, taxable income is all of your income totaled up, and then a few adjustments. That gives you your adjusted gross income. And then you subtract things such as your standard or itemized deduction, your qualified business income deduction from your business to get to taxable income. So we're looking at the number of taxable income, so not gross income. For a single person, 452,700, that is that top tax bracket. And for a married couple, 509,300. Those index every year for inflation. That's the current ones right now. So increasing just their overall tax rate from the 37% to 39.6 is the changes in taxes. Capital gain tax rate, if you have an adjusted gross income of over 1 million, So again, that is when we're totaling up all the income and adjustments you get to take for things like your self-employed health insurance and an IRA contribution, that type of stuff. If your income is over $1 million, currently your capital gain rate is 20%. They will move that to 37%. And you will, at over 1 million of adjusted gross income, also have a net investment income tax that actually kicks in when your income is over 250,000. But you will have a tax of additional 3.8% for a total of a 40.8%. And I'm sorry, that should have been up here. I'm sorry, no, down here. Take it to 37 and the 3.8, so 40.7% on your capital gain items. So ugly increase for that anybody with an adjusted gross income of over 1 million. And a lot of you are probably thinking, well, I won't be close to that. But remember, whatever it is that you sold that created that capital gain gets added to your income and increases your adjusted gross income. So if you've sold a second property, the entire profit from that, or if you sold your business, the entire profit from that would be added to your income and throw you over that in the year. This may very well be for a good reason for if you're selling something big, like selling your business or a couple properties in 1 year, is that you do it on an installment sale and spread your rate, your profit out over a couple years. Hold a note for it. And so you can keep your adjusted gross income under that 1 million mark, so you don't have the additional tax to pay on it. So that would be a possibility too of a planning strategy. But just know these capital rate things are going to be going up for people over 1 million of adjusted gross income. C corporations, corporate taxes are changing. C corporations, with the Tax Cut and Jobs Act of 2017, they all went to a flat tax of 21%. Previously, they were on a step scale up to 35%. And this proposal is to take these corporations, the C corporations, to a flat tax of 28% instead of 21%. So increasing their taxes there at that point. S corporations and partnerships, as this has not been in the news part, it has not been in my short summaries, but when I started reading the 114-page summary that Treasury has of the proposed budget, S corporations and partnerships, they are wanting to make the pass-through income subject to either self-employment tax, which is 15.3%, or the net investment income tax of the 3.8 on any return over adjusted gross income of $400,000. So this will hit many people that have businesses. They have an S corp, and that profit passes through onto their personal return. Most partnerships right now are subject to that self-employment tax, except if they are a limited partner and they're considered passive in the business. This will now make them subject to an additional tax too. That 3.8% is the Social Security, is the Medicare tax percentage. The 15.3 is the combination of Social Security and Medicare. So we are throwing that Medicare percentage in against these businesses. And they're also changing the way it applies back at the government level. Right now, when we pay this 3.8%, it just goes into the Treasury, because we already have the net investment credit. And this just goes straight into the Treasury. If this change happens, that now will go over to Medicare and not be going into the Treasury anymore. So, so they're talking about doing this and starting to make your S corporations and partnerships on your personal level do more of a pass-through. Part of the reason that they are doing this is because they have an issue with being able to watch and regulate S corporation shareholders taking a reasonable compensation. I keep pushing that with my S corporation shareholders, that you need to take a reasonable salary. And so if IRS audits you and it's not a reasonable amount, they will take everything that you pull from the company and make it your salary. So all of your distributions. So this is now going to be making more tax for my S corporation shareholders. And so this may, for tax planning structures, there have been times as a client has gotten to a certain income level that we've opened up a second corporation for them to run alongside their business. And so we are able to push money over into that C Corp, setting it up as a C Corp, because that C Corp money does not come onto your personal return, and it will pay a tax of 21%. And so then it may be advantage instead of that income being taxed at your income rate, which may now be 39.5%, plus the net investment income on it also. So there may be reasons for structuring and maybe reasons for having more than one corporation as your profits are increasing. So that would be a planning strategy that we would look for in the future. Having conversations lately with clients about the timing of taxing capital gains. They're really talking about this changing. And this is one thing that has, especially if you're doing long-term planning, has made a difference. So previously, we have always paid capital gains at the point when we sell an asset and pay the capital gains. And so that is true when you have given a gift to someone of an asset, or someone has passed away and left an asset. Previously, giving a gift to someone did not create any capital gains. They just got your basis in it. That passed over to them. And at the point they decide to sell it, they paid the capital gains on it. That will be changing at the point you gift an asset. You have to pay the capital gains on it. Okay, so the point you gift an asset, you have to pay capital gains. So if you want to give your kids some stocks that you own, when you gift it to the kids, you will pay the capital gains on that stock. So what it was worth when you got it, when you bought it, to what it is worth when you give it to the kids, that would be taxable. Same thing with someone who dies. Normally when I would pass away and leave my house to my son, Stephen, he would get a stepped up basis, what it's worth on my date of death as his beginning basis, and he would not pay any capital gains on it until the point he sells the house. That will now change when I pass, either on my final return, on an estate return, or they're talking about a new form to just handle these capital gains. My estate will, either on my last return or on this estate return or new form, have to pay the tax on the value of my property from what I paid for it to what it was worth on my date of death, and pay the capital gains at that point. Now then it will pass to Stephen at the higher capital gains rate, and he'll pay the difference between the fair market value when I died and whatever it's worth when he sells it. And then they've thrown one more in here that I thought was very interesting. Don't know who this will apply to, but if you have an asset that no gain has been recognized in the last 90 years, you have to go ahead and recognize the appreciated value of that asset starting in 2030. Okay, so they're starting this with January 1st of 1940. So any assets that have been owned as of that date and you still own it, so there's been no tax paid on it, you inherit it, no tax paid on it, so we're looking at when it came, so no tax has been paid on this at all. In 2030, you're going to have to total up the gain that it has appreciated over that time and pay the tax on it. That is a very interesting one thrown in there. Don't know if that one will stick. That is just kind of an odd thing, but it is there. The exception to this is any assets that pass to a spouse or charity. So those will not recognize the gain at that point. Of course, when the spouse dies, so if I pass away, things go to Doug, and then when Doug passes away, then it will have to be recognized. And they're allowing us a 1 million per person exclusion from the recognition of other unrealized capital gains from property or transfers of gift held at death. So there is a 1 million exclusion. Let me just go on to my next slide to go along with this. I really meant to pull that off. You got a 1 million exclusion under this bill. The current exclusion is 11 million. It's actually 11 million and some change because it gets indexed for inflation every year. So it's 11.3 something now. The 1 million also is set to be indexed for inflation. So it'll be 1 million in the first year, and then it will start being indexed. So it'll keep creeping up the way our current one does. But that is a big difference because this is looking at what you have at the point you pass away. Now it's 1 million per individual. So for a married couple, that's going to be a 2 million total, because the first spouse that passes away can use $1 million. What they didn't use of the $1 million passes over, is called portable, to the second spouse, and they get the rest of that. Same thing is true with the 11 million that we currently have. So if I have a client that is a married couple that we're doing planning with about what the estate values will be worth, I just go ahead and automatically double that to 22 million, because it's portable to the spouse. So that will be a lot of changes and differences of what we're looking at when we're looking at long-term planning. There is a special timing of payment for the taxes that would be due for a family-owned business. So in this proposal, if it's a family-owned business that we're talking about, the tax will be calculated. So the amount, so the value to the person who owns it, and then up to what it's worth on their date of death, that gain and that tax will be calculated, but it will not need to be paid as long as the family-owned business remains in the family. So then it will need to be paid once you pass it out of the family or no longer is in existence. And they do also have a 15-year payment plan that they can set for that too. So that will be craziness on that part. But there is a special exception for a family-owned business in this. Okay, so we're going to see a lot of changes around capital gains when we're talking about someone giving stuff away or when someone passes. What has happened in the past is we've had this automatic step up in basis, and that's kind of been eliminated then, because previously what would happen, I pass away, and my beneficiaries get my assets at their current fair market value. So if I own stock that I paid $10 a share for, but it's now worth $40 a share, and I pass away, and Stephen is the beneficiary of this, he gets it at a value of $40 a share, and when he decides to sell it, he only recognizes any gain from $40 a share to whatever it's worth when he sells it. That's current rule. Now, for Stephen, that will remain the same, because I own that stock now at $10 a share. I pass away, I have to, my executor will need to pay the tax for the difference between that 10 to that 40. So then it does still go to Stephen at 40. So he doesn't have it going on, unless I fall under the exception that I'm less than 1 million in assets. My total value is less than 1 million, because I won't have to pay the capital gains tax on it. The state won't have to pay the capital gains tax on it, but now it passes to Stephen at my $10 a share, not the $40 a share that it's now worth. So now Stephen is going to pay the tax on that $30 difference. So craziness on that. I know I see we have a couple things popping in chat. All right, there you go. Stephen just threw in the chat for me. I have a short version of the presidential budget written by the, say it again, Journal of Accountancy. That information for you there in the chat. So if you want a short version of that, this is not the 114 page, and it really does just list things that are changing and not a whole lot of detail on it, but at least you can see if any of those are starting to affect you. He also put into there, we will talk in just a few minutes about things that are changing in Maryland sales tax, and that is the more detail in the digital sales tax things in Maryland. Okay. So this step up in basis issue is now making it more important than ever that as somebody is gifting usually to family members, you don't usually gift to people who are not family members, in their lifetime, that they file that gift tax return. So the current exclusion, and I'm not seeing anything in this information changing the current exclusion of $15,000 a year that you can gift and not have to report it on the gift tax return, to now needing to do the gift tax return so that you're establishing this basis for your beneficiaries and you are paying the capital gains tax. So we really think of it, when we strike a check to our kids that we give them more than $15,000 a year, that's a gift tax. We always keep thinking that the kids who got the money pay the gift tax, is the person giving the money. If there is gift tax, because the first $1 million you can give away without any tax. But this is also true when I decide to put my kid's name on the house. So when I add them to the house, I've actually gifted them the value of the house whether I put their name completely on the house and took mine off, or I put them on jointly with me, I've given them half the value of the house. So those would be things that we need to be talking with our clients about as they are doing it, as they're thinking about doing it, knowing that this is now going to change. It becomes more important than ever. And really making that making a plan as you do those things. But a lot of times when you just change and put the name on the house, a lot of people never thought of that as a gift, but it actually is. It actually is, and can be good and bad. We can always, in every individual situation, talk about the good and the bad of doing that. Again, we'll talk about it from the tax side. You may be working with an estate attorney who's talking about it from a planning side, and maybe a nursing home planning, et cetera. There may be a difference in when you would want to do that. So I can tell you on the tax side what the consequences will be for both you and the beneficiary. Attorneys can talk about other things with you too. So that step up in basis technically is gone because it is whatever basis you have. So if I was still under the exclusion, my basis is still that $10 per share on that stock. But if I had to pay the capital gains tax, my basis in it is now that $40 a share and passing it over at the $40 a share. So that step up in basis can be a really big deal, especially when you're talking about businesses. You guys are business owners. And if you're talking about passing your business on, there is a value to your business. So looking at getting a value done, that is a service that we offer. We do business valuations. I've done this for a few of our clients. Usually it's been happening as they're thinking about selling the business, or they're thinking about transferring it to their kids and they want a good value on a good, here's what the business is worth that I'm transferring to you. So I have done those. I am not a business valuation appraiser. So there is a certification for that. So if you need it for something more substantial as a backup, we would have to get you connected up with a business appraisal. But if you're just wanting to know what it's worth and what the possible sale price would be for it, because you're thinking about selling your business, we can give you that kind of number to get a number in your head. And also then what your tax consequences would be. I really like doing that with clients when they're talking about selling a rental property or a second property that's going to create a tax consequence for them, is really giving them an idea of how much tax that sale is going to create for them, because that gives you more information. So as you're negotiating the price with a potential buyer, you know how much you're willing to come down or how much you really need to be getting out of it to be able to also pay the taxes on it. So a bit more information you always need. So those are the things I wanted to point out that are very business related for business owners, these changes on the proposed budget. Again, don't have a bill yet, don't have anything firm. So we'll keep an eye on this as it goes through about what changes might be happening. And if you have any specific questions about, can you really keep an eye out for this or that, put it in the chat, shoot me an email, just let me know sometime. I'll make sure I'm keeping on top of that. And we will talk about this as we see any progress in these things, okay? And let me just mention here, Maryland changes. Just want to remind you, we've talked about this before. Maryland changed their due date to July 15th on all of their tax filings. So that includes your Maryland tax return, your Maryland sales tax reports, your Maryland withholding reports. All of those have been pushed to July. So remember that, that'll be coming up on you here. And don't forget, for the sales tax, we have that special sales tax credit for the March, April, and May of this year. You're going to have to file it online, and that's due in July. So your sales tax are due in July instead of earlier. So remembering that. And then the Maryland sales tax on digital products. This came out this year and was effective starting March 14th. You guys are probably seeing, if you have things that are a digital product, that you're starting to see sales tax on it. So this would be your Netflix, should be a change in the price that they're charging you. I'm seeing the change in the price of a couple softwares that I use that are online softwares that I pay a monthly or an annual fee to. They're now including sales tax on that. Pay attention if you deliver any type of digital products. that you need to look at what is taxable on that. And Stephen, that is the other document Stephen put into chat, is the rules for sales tax. And they give some really great examples. I had been mentioning to you guys about the tax course that I teach in the fall, that now I'm going to have to start charging sales tax on it because I do it on Zoom. But as I look at the information more now, if it's an educational product and I'm doing it live with the students interacting with me, I do not need to charge sales tax on it. But if I had all these classes as just pre-recorded classes and there was no interaction with the instructor, then I would have to charge sales tax on the class. So there's some real nuances to that thing. If any of you are a photographer, really paying attention to that and really maybe needing to bill separately now. Here's what I charge for the setting and doing the photography. And then here's what I charge for delivering to you the digital format of those photos, because the digital format is taxable. But if you bill out separately the other part of the work that you're doing, that's not taxable for sales tax. And so you'll want to start, if any of you have it all as a combined price, you'll want to start splitting it. Okay. And then you may change how you split that. So looking at those things, so if any part of what you're doing includes a digital file that you send or use in any way, you need to be looking at those sales tax rules for the state of Maryland. Okay. Accounting boot camp. Did just want to let you guys know we will be pushing this out in more information, but we are having accounting boot camp starting July 19th. What are your books like? So this will be for QuickBooks and either the desktop or the online version. We will be running a 6-week boot camp to help you get your books in good shape. We do this by having a Zoom meeting. We will do a little bit of instruction at the beginning of the session, just talking about a basic accounting principle, and then you will work in your QuickBooks with us online with you. And as you need to ask a private question, we can pull over into a breakout room. If you're just saying, you know, where do you put this? I mean, you might not mind other people hearing that. So we will do work on your books with you. So we'll share your books. We'll have you set up that you can share your books with us, either through online, inviting us as an accountant, or we have a little software that allows us, if you have the desktop version, for us to be able to access your version for you too. And we will get your books in shape and help you get that through, and all those things that have been never right, or if I have complained to you at tax time about that book's not being right, this will help give you a good set of financials. And a good set of financials is not just the benefit of getting a good tax return. Although I will tell you, we just took on a new client and we're starting here and then 21, but we're looking at their books. They're on the online QuickBooks and they haven't reconciled the bank accounts since June of last year. And they're like, well, but it matches what the bank says. And I looked through it, I'm like, well, no, it doesn't, because this deposit doesn't reconcile, and this didn't reconcile, and this didn't reconcile. And it looks to me like right now, just these little things that I'm seeing, that you guys probably claim $5,000 more of income on the tax return you just did than what you actually had last year. And there may even be more, because we haven't reconciled either the credit cards or the bank account. So not only does it help you with your taxes to have a good set of books, so you're getting the right information for your taxes, but as you're wanting to make financial decisions about your business throughout the year, for you to be able to quickly click a button, pull a report up that shows you your profit margin per product type, or shows you how much you're spending on X, or what you expect to be spending, so this should be set aside. So being able to make good financial decisions and forecast financials for your company really starts with having that information organized in a way that can give you those bits of information. So we want to help you with doing that. It will help you guys be better business owners, run your businesses more efficiently, and that actually helps us on the other end, because if you have a clean set of books, it makes it much easier for me to get your tax return done. So we like doing it that way too. So two benefits there for you. So we will be doing that starting July 19th. It'll run for 6 weeks. And if more information is on the Saunders website, and you can sign up for it there. Or if you have questions, you're more than welcome to call the office or shoot me an email. We'll talk with you about those. So that's what I have for you for today. Be very glad to go ahead and take any questions. We don't have a large group. So if you just want to pop off of mute and ask the question, that'd be great, or you can type it in the chat. So while you're thinking of your question, just save the dates for next July. Our next Wisdom Wednesday will be July 28th, and our Tax Tip Tuesday will be July 6th. we will send our emails out for you with the topics of these. And hopefully we'll have some more information of what might be starting on these budget proposals for us on the July 28th meeting. If not, there's other good topics for you guys as business owners. But if you have questions or have an idea of a topic, be glad to hear it from you. And so do we have any questions? Yes, Mark, go ahead and go off mute and ask your question. Hey, Mark, good to see you.
Hey, thanks. So I work in film, and the film payroll companies will only pay your LLC or your loan out if you have it as if it's an S corp. My LLC currently isn't an S corp. It's not an S corp, but I remember you mentioning in an earlier conversation that it's sort of there's like a certain profit. You need to be doing certain numbers before it makes sense for you to take on the added expense of either converting that LLC into an S corp, or what I'm thinking now is just straight up making a new entity that is an S corp.
Yeah, so I wouldn't bother with a new entity unless there's another reason to change, because it's an easy thing to switch an existing LLC to an S corp when the time happens. But I don't see a tax advantage. So I'm going to talk tax side of this, of switching over to an S corp until I start seeing your bottom line profit being a consistent $60,000, $70,000, $80,000 a year, something in that range, before I would start talking to a client about switching to an S corp. Your consistent profit needs to be more than what you would pull for a salary for that to be beneficial. Okay, so it's usually the 60, 70, 80,000 range of bottom line profit, not gross revenue, but bottom line profit after expenses, when I start talking about being an S corp and there being an advantage to it. And when we start talking about that, Mark, for example, we will actually look at what your numbers are looking like and actually be able to tell you. So if you had these numbers and you were an S corp, this is how much you would save in taxes. Here's what your extra expenses will be, because now you got to do a payroll company and you got to do a corporate tax return. So you're gonna have these increased fees, but this is what you would save in taxes every year. So when that makes sense for the difference for those two things, that now I'm saving more money than I'm paying to have the S corporation, that's when it will make sense for you. So yeah, it's usually around that profit margin that we see that.
Okay, so if I'm W-2, I wouldn't be able to claim, as long as I'm still W-2, I wouldn't be able to claim like travel, like flight fees or
correct, because I know you have
expense.
both. For some of these clients, you work as a W-2 employee, and some of them pay you as a contractor. And so W-2 employees cannot take any business expenses. And so you really have to keep those separated, because they're not part of the business, they're part of being an employee, and there's no deductions for those expenses. Yeah, so that would be the other thing of the question would be, the companies that you work W-2 for, would they be willing to treat you as a contractor? Because it may be that their standard is that we just treat everybody as an employee. So
Thank you.
Yeah, so that's what you'd have to look at. Yep, you got it. All right, in chat. Thank you. And yeah, all right, so we're good on the chat. Yep, check out that boot camp. All right, any other questions? All right, guys, we are good then for today. Hope you guys enjoy the day. Those of you that are local here to me, we had some pretty bad storms that went through earlier this week, and there are many places without power, so everybody seems to be back up and running now. I know my church was without power until this morning, and so the storm came through Monday evening, and they just got power back this morning. So doing that. Good thing it was a church, because then, you know, it wasn't a service. It wasn't a Sunday we were over, so that worked out. Okay. All right, guys, thanks very much. Talk to you again next month.